What's up, guys, and welcome back to the channel. I'm Ty, and this is Stock Muscle. So the company I want to talk to you guys about today is a company that you all know. It's one of the largest consumer electronics brands in the world. The company name is Sony, and the ticker symbol for the company is going to be SONY. Now, here are the three reasons I like Sony. So we're going to get right to it. Reason number one is we are in a new console cycle. Sony just released the PlayStation 5, and we're in a unique scenario. So that scenario is that Sony can't sell enough of the PS5s because they can't make enough. So if you guys know economics, like I know you do, we're in a situation with Sony where the supply is underserving the demand. That's always a good thing. Whenever the PS5 does go on sale, whenever a retailer is able to get a few, they sell out almost immediately. Sony has big plans to ramp up sales this year. I think they want to do about 14 plus million, and we'll get into that later. But reason number one is we are in a new console cycle. Apparently the PS5 is more profitable than some of the past PlayStations, so I'm bullish on that. Reason number two is the company is actively buying back shares. So Sony is in the market. They're buying their own shares back. As they retire shares, that heightens the chance that your shares may become more valuable. I'm a big bull on share buybacks. The third reason is this. Last year, as you guys know, COVID hit, and we didn't get as many movie releases. One of Sony's biggest segments is their pictures segment. We're expecting their pictures and movie releases to pick up into next year. Profits gotten hit. We're going to look at that too in the pictures division, but I expect that to change going forward. So let's look into it. Full disclosure, guys, I already own about 100 shares of Sony. I'm not planning to increase or decrease my position. I got 100 shares. I like where I am. I'm going to ride this out. But let's look into the fundamentals. Let's look at the revenue, net income, etc. You guys know what we do here. So let's get into it. All right, guys, first things first, let's take a look at the company's revenue. Any company that we're looking at, we want to make sure that the revenue is growing and that the net income is growing sufficiently. So let's take a 5-year basis. Looking back at 2017, revenue was at $70 billion. That's grown to $84 billion. So good job there, Sony, growing the top line. Let's go down to the bottom line, net income. Net income has grown from $1.2 billion to $11 billion. So Sony's doing a good job of growing the top and bottom line. On an earnings per share basis, bottom column in green, guys, earnings per share on a 5-year basis has grown from just 53 cents to over $8 per share. And Sony does have quite a bit of shares outstanding, so that's impressive. Earnings per share looks good. So top line looks good, bottom line looks good, earnings per share looks good. The question is, do we think this can continue going forward? My argument is yes, because like we said, the pictures division is going to recover. We are in a new console cycle with a more profitable system. Apparently Sony's making a little bit more money off the PS5. I think revenue is going to tick up going forward. And that's not even mentioning their sensors business, but we'll get into that later. I think this can continue well into the future, especially with a company like Sony. They know what they're doing over there. Secondly, let's take a look at the company's cash position. We want to make sure that the company has cash, because if a company has cash, they can do things for me as a shareholder. They can issue a dividend. They can start a share buyback program. They can make investments in new brands. They can acquire new brands. They can make investments in new systems or what have you. They can generally do things that are going to make me more money. We want to make sure the companies we own have good cash positions. So 2017, cash was at $4.6 billion. That's grown to $12 billion. That's a plus. The second bullish stance that I mentioned in the intro was that Sony is currently buying back shares. That's what I'm talking about, guys. When you have cash, you can do things like that. The company is actively in the market buying their own shares. And if you look at the stock's performance over the last few weeks, you can kind of see that having somewhat of an effect. So cash looks great for the company. Question number 3, guys, and this is pretty new for the channel. We want to get into basic valuations using things like the PE ratio. Question number 3 is the company cheap? Are we buying Sony cheaply? So let's take a look at the old PE ratio. I know a lot of guys may disagree with it at this point. They may think it's archaic. I still believe in it. It's not the end all be all, but from a basic standpoint, it's a really good way to measure the valuation of a stock. So let's look at the old PE ratio. So it's the second line highlighted in yellow. what we want to do is we want to compare Sony to itself, its PE to itself. We want to compare it to the index that it's trading in, and we want to look at the 5-year. So let's start with itself. Currently, the PE ratio for Sony is 11.6. Not bad. That's considered low by almost any standard. A PE of 11 is generally considered low. Typically, anything under 20, you'll hear people refer to that as a company as having a low PE. 11.6 looks really low. The lowest it's been since 11.6 is, if you look at 2019, it's been at 11.1. In 2018, it's been as low as a 10. But that's fine. I could safely say here that we're buying Sony at a low PE of 11.6. It's been as high as, if you look at 2016, it's been as high as 75.3. So I'm comfortable here. I feel like we can buy Sony and feel like we're paying a low price for it when we're looking at the price to earnings ratio. The 5-year price to earnings ratio is 24.7. So we're looking good when compared to the 5-year PE. The index that Sony currently trades in has a PE of 19.3. We're looking good there as well. Our PE is at 11. The index that we trade in is at 19. So those are all pluses. I could safely say that if you were to start a position on Sony right here, we're looking good. This is a low PE stock, and I would have no qualms about starting a position right here. So revenue looks good, net income looks good, earnings per share looks good. The company's in a good cash position, and we could safely buy the stock right now and feel like we're paying a low price for it. So those are all check marks. That's a big plus for me. So let's get into segmentation, guys. We broke it down a little bit in the intro, but the company's #1 segment right now is games and network services. This is why I'm bullish on the company, because Sony's really pushing their games division out ahead. If you look at the company in the past, the #1 division may have been their consumer electronics brands, but Sony's been very wishy-washy with their consumer electronics brands. Televisions, the prices of televisions have universally come down. You got new competitors in the market like TCL and these budget brands like Hisense that are dramatically killing the margins on TVs. Cameras, Sony has always participated in a very competitive camera market. It's just that their consumer electronics brands have always been very dodgy. So they're leaning on games, which I like because they have a dominant system. They've always had a dominant system, and I think that's going to continue. So let's look at what happened in 2019 when compared to 2020. I highlighted it in green for you guys. So game network services sales were up this year. So they went from $1.9 billion to $2.6 billion. That's a 15% increase. The company wants to sell more PS5s this year. The question really is, guys, can they do it? Because we know that we're in an environment where you can't get enough semiconductors right now. Sony has lofty goals for the PS5 this year. The question is, can we get enough semiconductors? But we'll see. We'll see what happens with that as it plays out. The #2 thing I want you guys to look at is, and I highlighted it in red, is the picture segment. That's down 19% this year, or last year, I should say, in 2020, because, as we know, COVID hit and the movie theaters were shuttered. A lot of the production companies started to go directly to streaming, which ultimately going to hurt the movie theaters. But Sony just wasn't able to push out as many films. Production was just shut down for months as well. But I think going forward, and this is pretty much probably consensual, everybody will probably say the same thing. Pictures are going to recover going into 2022 and the back end of 2021. So this is going to be a plus for Sony. One of their major segments, their #3 segment, is probably going to see a huge increase in profitability going forward, in sales going forward. So that's going to be a very bullish thing for the company. Last thing we want to look at is PS5 forecast. So I highlighted it down in green at the bottom of the screen. Sony wants to sell 14.8 million units this year. They want to exceed what they did in year 2 of the PS4. So it's safe to say they want to hit about 15 million systems sold this year. Now, like I just said, guys, here's the problem. Can we get enough semiconductors to make that many systems? Who knows? But let me say this, if we get word that the semiconductor shortage is starting to alleviate itself, Sony in their last earnings call even alluded to maybe going to a different chipset, one that might be more readily available. If we hear about anything great with the chip shortage, look out, because I believe the stock's going to take off. So I'm a bull there. Sony has big goals for the PS5, and I like that. They also mentioned that the PS5, and you guys may be surprised to hear this, is a net contributor to revenue going forward. Some of you may know that the PS2, 3, and I believe the 4 for most of its life was being sold at a loss. So the company would sell these systems at a loss and try to make up for them with software and network sales. That's changing from what I got from the earnings call. The CFO said that the PS5 is a contributor. That says to me that they are making some money off the hardware this time, and I like that a lot, guys. So let's do a quick recap, guys. Sony has a bunch of things going forward. Right now, we're in a refreshed console cycle. That's A. B, the company is actively buying back shares. C, their pictures division is gonna probably recover in the next year and a half. Their third largest segment is gonna start to see its sales pick up again, and I'm extremely bullish on those three things. This is probably a more contrarian or value pick. Sony, from what I can see looking out into the market, is pretty ignored. If you look at it on stock Twitch, it probably has about 200 followers. Nobody's paying attention, but if you're a value / contrarian guy, this is probably right up your alley. But that's my thesis on Sony right now, guys. Like I said, full disclosure, I already own a few shares, about 100 shares. I'm planning to hold for a while, unless the story change. If I hear anything negative with the semiconductors, if they think the shortage is going to go a little bit longer, and I feel like Sony's not going to meet its PS5 sales goals, maybe I'll reduce or even liquidate my position, but I'll keep you guys posted with that. And I'm Ty. This is Stock Muscle, guys. If you have any questions or comments, leave it in the comments section. Hit the like button if you like the content. Hit the subscribe button if you want to see more content. I'm Ty. This is Stock Muscle. I'll talk to you guys later. Thank you.